Hey everyone, welcome to another episode of Founders Table. This podcast is focused on conversations with current founders to deconstruct their lessons and tactics in order to help you build your own startup. If you like this podcast, don't forget to rate and subscribe in your podcast app. This will keep you up to date on the latest episodes, as well as help others find out about the show. Today, my guest is Max Cho, founder of Coverage Cat, a one-stop shop to buy insurance for high net worth individuals. Prior to Coverage Cat, Max worked extensively in tech and finance at firms like Microsoft, Two Sigma, and Google. Max is passionate about fixing the problems in the insurance industry and believes that most people buy the wrong policies, overpay for them, and don't get coverage for what they need. In today's episode, we talk about Max's personal issues with insurance as a teenager and the motivation to start Coverage Cat. We talk about the inefficiencies of the insurance industry, and we get Max's take on AI's impact on insurance. Now, without any further ado, I give you Max. Okay, Max, welcome to Founders Table. I'm really happy to have you on the show.
Great to be here.
So, before we start talking about Coverage Cat and your startup journey, one thing I noticed is that you went to undergrad for cognitive science and then ended up getting a master's in CS. I'm curious if that was the plan all along or if something kind of shifted your trajectory as you were going through undergrad.
The way I chose an undergraduate major is not necessarily one I'd recommend to other people, but I cracked open the academic regulations handbook and I circled every course that I was interested in taking, and then I used a SAT solver to find out which majors that fulfilled the degree requirements for. And so cognitive science fit the bill. Which was like, okay, great, done. I took a lot of computer science courses in undergrad, but I think for some reason I think I didn't want to take the math courses associated with it. And so I ended up getting a cog sci degree and then doing grad school for computer science, which I wouldn't necessarily recommend if you're really passionate about programming, but it worked for me.
Got it. And when you were pursuing that cog sci degree, did you do it? I mean, it sounds like it was coursework, bottoms-up approach versus like an end goal in mind, but did you develop kind of an idea of what you wanted to do after graduation?
I think that would suggest I had a lot more foresight than is available to maybe my 20-year-old self. I had a vague notion that there were things I was interested in, but I don't think that my academic choices had a huge effect on that. I mean, in some ways they did. For instance, some employers refused to consider me for a job because my degree didn't say computer science on it. So that's unfortunate, but other than that.
Got it. Then let's fast forward then to today. You started a startup in the insurance space. I guess a lot of jumping off points, but I guess what led to the genesis of, not really knowing what to do in college to doing your own startup now?
Insurance is a great area for people who are mediocre programmers because it's actually a much easier programming target. Ultimately, the business of insurance is about moving around PDFs as rapidly as possible. And the PDFs are a much more amenable environment to how programming languages interact with people, in the sense that you don't have to worry about, like, let's say robotics has a lot of real world problems. There's a lot of unsolved challenges in it. And really, really smart people have been working on that for years and have made very little progress. Whereas in insurance, the primary issue is really an industry ability to capture talent and an industry ability to effectively deploy ideas that have been mainstream in computer science for decades into it. And if you look at the statistics on American industries of where people spend a lot of time and labor, sure, construction, bricklaying is one, but it's very hard to build a bricklaying robot that works in every environment. And sitting in a call center for an insurance company is another. And I feel like that one is much more amenable to computer science.
Got it. And what even tipped you off that kind of the insurance industry was like this? Out of all the things you could have done, why insurance?
This one is actually more personal. Basically, when I was a teenager, I had to go deal with a whole bunch of insurance headaches to replace a bunch of teeth I knocked out. And I got good at reading insurance policies and figuring out what was covered. And I figured you learn, maybe this happens to everyone the first time something awful happens to them. You really learn that insurance is just a contractual promise, and reading that piece of paper that you never bothered to read can produce significant financial variance. So I knew that already. I knew that when I was 17, which is not a thing a lot of 17-year-olds have to know, unfortunately. So over the years, I have long felt like this is a place where there's opportunity for it to be better.
And so then now, places today, Coverage Cat. What is Coverage Cat? What do you guys do? And let's start there.
So insurance is this massive industry which has hundreds of billions of dollars a year of Americans' expenditures, and it is also one of the least financially efficient products available to people. So if you go and buy, an S&P 500 fund, you're probably paying, a tenth or a hundredth of a percentage in annual fees. Whereas if you go and buy, standard insurance policy, oftentimes you're going to get back maybe 50 cents on the dollar. So you could think of the fees as 50% or something like that. And it's a really high fee environment, in part because of all these extreme inefficiencies throughout every part of the insurance pipe. And one place that there's really severe inefficiencies is people getting the right insurance. Obviously getting the right insurance should be trivial. If you just saw every price for every insurer in front of you, you could just click buy on the correct one. But it turns out that actually knowing which insurer will offer you the best price and is willing to take you on as a client is a non-trivial technical problem. And that's really what Coverage Cat focuses on. Our goal is to take millions and millions of observed prices, build models to figure out which insurer is the best for you, and then just show you that one.
It reminds me a lot of health insurance, which is also famous for having opaque pricing and high fees. I guess, and don't want to derail the conversation, but when we talk about insurance, is health insurance a much different category from general insurance, or is it a lot of overlap?
Health insurance is very different from property and casualty insurance, which is the main line of what Coverage Cat focuses on. We do advise our clients who have specific health-related questions. I'm a licensed health insurance person, so it's a part of what we do. The reason that health insurance is so the reason a company like Coverage Cat is not necessary for most Americans' health insurance is most Americans effectively have no choices in health insurance. And that lack of choice makes it so that you don't really need an advisor on the topic. And that's just because you just get what your job gives you, whatever. Or if you're on Medicare, you get what Medicare. I mean, there actually is a major cottage industry of Medicare Advantage advisors. And I know some startups in YC, for instance, in the space. So if that's the thing you're interested in, we can definitely talk about that. But I'm not the chief expert on that topic.
Got it. Then in terms of Coverage Cat, I noticed that one thing you guys seem to be focused on is individuals with high net worth or high income. Why that particular focus?
This kind of is almost the exact same reason as the health insurance. When you're really poor, choosing an insurer for, let's say, car insurance. Choosing car insurance when you're really poor is very simple. Your goal is to buy the minimum coverages that you can get away with, and if you get into a serious wreck, your actual plan is bankruptcy, right? You're not actually planning on paying whoever you harm. Whereas when you're wealthy, you actually have a very different insurance problem. You both have the question of, I have assets that are worth protecting, and the wealthier you are, the less insurance you should buy at the low end, because that's actually a risk that you can bear personally. When you have $500, a $1,000 crash can bankrupt you, or it can be a serious financial hardship. But when you have $5 million, if you total your Toyota Corolla, you can just go buy a new Toyota Corolla tomorrow. And so it really changes your relationship with insurance. And what we've seen is wealthy clients are systemically bad at buying the right kind of catastrophic insurance against rare things, and instead overbuy this terrible product at the low end.
When I think of insurance, at least from my personal case, it's something I simply just don't think about unless, of course, I am moving to a new apartment, or like the renters insurance doesn't work, or something happens in my life. I guess one of the, like, going through YC, one of the advices, solve for a painkiller problem, something that is that people can't do without. But I guess what I'm curious about is for Coverage Cat, how do you maybe acquire customers, and since insurance might not be something that is top of mind for most people?
I think insurance is not always top of mind, but the insurance industry is going through a really hard time right now. In most states, consumers are facing 25, 30, 45% price increases year over year or over the past 2 years in insurance. And that's pretty significant, especially when we remember that insurance is actually one of the larger expenditures of Americans. And it's not really discretionary. It's a little discretionary, but it's not that discretionary. And so if you're facing a pretty significant hike and you're already paying a lot of money, you're really going to notice. Like, we have clients who are paying $20,000, $25,000 a year for, let's say, home insurance. And if you get a 30% price hike on that, that can be more than your mortgage. And so to the extent that people don't pay attention to it, it's often, I would say, out of kind of a sense of powerlessness, in which they feel like, sure, this is just like a tax on life. But that's not true. Insurance is a thing that you can do better on. And really, my view is, don't try to figure it all out yourself. Make this my problem. Coverage Cat is obsessed with doing the right thing for you. So of course we're gonna do what we can to help you.
Well, what are what are the most common mistakes you see when consumers, like, let's say, high income individuals, buy insurance?
If you bought insurance yourself online, there is a very high chance that you bought coverages that you don't need and will never use and are paying for. And if you use them, you will regret it. So just to pick on car insurance a little longer here. If you bought like windshield crack replacement, please, I beg of you, do not file a windshield crack claim, because it's going to make you have 7 to 10 years of higher auto insurance premiums that you could just pay for that crack. Please don't do that. And at the same time as you bought that terrible coverage there that you'll never use or should never use, you might not have bought a coverage that will actually protect you to the tune of millions of dollars. And many people just don't even know that those options exist. They don't fully grasp that there are ways to get millions of dollars of liability coverage for hundreds of dollars. And so that lack of knowledge is really what I see as the most common mistake.
Yeah, actually, now that we talk about it, this reminds me that last year we have a house and we had some water damage on the house. The repairs, I think, were around $20,000, but after looking at insurance premiums, the deductibles, and how much our insurance would increase to actually have this covered by insurance, we decided just to pay out of pocket because it wasn't worthwhile. And it's just like the silly thing of like, why the heck do we even have insurance if it's like, unless the entire house burned down, it doesn't seem like it's worthwhile to actually cash in on that.
If you're even close to the gray area where you're like, I don't know if I should file this claim or not, that's a sign that you're probably overbought insurance. My personal insurance, if I'm filing a claim, wow, it's definitely going to be worth it. I'm going to get a lot of money back. And so that's my view on how rich people should solve insurance, because otherwise you're just wasting money, basically.
In the early days of Coverage Cat, I guess, what do you remember your first customer, and how did you get them?
I do. My first customer actually appeared in our seed round pitch deck, so he's very memorable to me. This is the nature of consumer businesses. You end up talking to people who are just like your peers, who are around in your ecosystem, because only people who already trust you are crazy enough to be your first customers when you're just starting out. Those are the people that are going to be accessible to you. It's different if you're making, I don't know, B2B SaaS or something. That's just a different category. Although if you live in San Francisco, maybe you're just, it's those people are falling out of every corner that you can find. So our first customer was a software engineer in California who is worth a couple $1 million, and he had bought a $25,000 maximum policy for his auto insurance. So if he got in a serious wreck, it would happily pay $25,000, and then he would be on the hook for every remaining dollar. So if you hurt someone's serious problems, well, he was going to go bankrupt from that. And this was kind of the moment in which I realized that most people don't shop for the insurance the way that I shop for insurance. And if I could make it so that you could have the max view of insurance at a click, that was maybe a viable product.
Got it. And then in terms of this first customer, like, did they know that they had a problem, and then did they end up using Coverage Cap? Or
so his view, he never. This is actually a dangerous way to build a product. He didn't realize he had a problem. I would say this goes against the YC view of like find people, thirsty for a solution. And then he was like, "Oh, I've got insurance. That problem check done." But in fact, he had just garbage. And I think it's hard to ski uphill in that kind of world. And so if anything, maybe I should have realized that we had done something wrong here, that this was not going to be that easy. And I would be the first to say that things are not always easy, especially in insurance. So maybe we learned the wrong lesson there. Maybe we should have found a problem where people were howling about it instead. But this is a real societal level problem. If we can fix this problem, millions of people will have much better outcomes financially. Whether they realize that or not, that's a much harder question.
Right. This is one of those, like, you didn't know you have a problem, but by the way, here's a problem that you have.
Right.
Then that makes me wonder about your growth strategy. What has been effective or is effective at kind of growing your customer base and just awareness of what you guys do?
Well, right now, I would say the hardship in the insurance industry is what is giving some wind at the back of our sails. So there's tens of thousands of people living in states like California or Florida who are literally unable to buy insurance. Like, they are struggling to get the thing that they're looking for. And that makes it so that there's an opportunity for companies like Coverage Cat to step in and help out. At the same time, there's a reason that hardship is going on, and that hardship, unfortunately, is a headwind at the same time, because insurance companies are really looking to shrink right now. And that's unfortunate. It means that there's fewer options in the market for people.
So then right now, would it be right to say, like, do most people find you through, like, SEO, like just going through Google?
I see. Yeah. It's a really weird mix. I wish there was like a single answer for this. So let's talk about some weird things that have gone on. So a couple of our things on TikTok have gone like micro viral. Like, I'm talking like 1 million or 2 views. And a lot of the customers who see those kinds of videos are in this unfortunate place where, like I kind of talked about at the beginning of this, there's not that many insurance choices for them. So when we get customers from those kinds of sources, the answer is often depressingly like, well, it's not a lot to do here. For our wealthier customers, I would say we are overwhelmingly getting them because Coverage Cat's the easiest way to buy certain kinds of wealthier person insurance, like umbrella insurance. We're one of the few places, maybe the only place that you can buy it online in California or Florida. No phone call required. You just sign up and you get it. And so that's working well for us in the sense, like, we have this thing that other people can't really provide or not interested in providing. And so if you're searching around for that already on Google or whatever, you're going to run into us and we'll do it. We'll actually succeed. Hilariously, a bunch of our competitors, or I don't know, competitors is not really the word, a bunch of incumbents buy ads on these kinds of things that will never actually even lead you to the product that you're looking for. So if you go Google for umbrella insurance right now and you click on some of those ads, you will not end up getting umbrella insurance, which is wild to me. That's just like incredible.
I guess they're just looking for click-through rates of, hey, we got more traffic this month. But
well, how much do you want to know about the gory guts of the insurance industry?
I would love to. So this is an hour-long podcast, so we have time.
There is a very large business in which several public companies compete that are ostensibly insurance companies, but in practice never sell insurance. Their sole business is in selling personal information to insurance agents to cold call you. And so these are companies that are basically extracting an ad arbitrage in which they're buying slots on Google, let's say, and then customers are unsuspectingly entering their information, believing that they will get insurance. And then in practice, those companies, their sole job is to resell that information to the highest bidder.
Data brokers, essentially, but for the insurance
Yes.
industry. Yeah.
And sometimes they'll sell it to you on a basis of exclusivity. Sometimes they'll sell it to everyone. So, your phone number is going to get sold to 100 different agents who are all going to call you that day. I wish, if these companies were great at getting people the best insurance, Coverage Cat wouldn't need to exist. But instead, these companies are just so bad that there's a real consumer trust problem. Most people think Coverage Cat's like that, and that we're going to resell their information, which we never do. And then also, if you have used one of those things, you pretty much are like, oh, I'm never buying insurance online again. This is awful.
Got it. And I'm curious, how does Coverage Cat work? So I actually went through the Coverage Cat intake recently because I'm getting renter's insurance. And so, fill out a bunch of forms and saw that, there's like a 2-day process to pull quotes from a bunch of the major insurance companies. I guess behind the scenes, are you, how are you getting those quotes? Or I guess, is that the secret sauce?
That's one of the secret sauces. There's no super mystery. So in most lines of personal insurance, rates are fixed. They're filed with the state regulator, and there's a fixed deterministic algorithm that takes in a bunch of underwriting information about you and spits out a price. And in like an ideal world, let's just dream for a moment. Every major insurance carrier, and there's only like 400 insurance companies in the US. There's really only like 10 actual major ones, but you could just see 400 prices. You could just imagine some kind of beautiful Python API. You just throw in this blob of user data, and it spits back an array of prices. But that's not what happens, right? So in fact, quoting is so tedious that it's a job that hundreds of thousands of people do every day as a full-time job. And the Coverage Cat approach is, can we use a machine-generated corpus of millions and millions of prices and build models on top of that infer and rule out which insurers are likely good for you and not? And being able to do that at scale is what enables us to do the other thing that Coverage Cat does, which is suggest the best insurance for you even if we don't get paid for it. Normally, you can just imagine, if there's somebody in a call center clicking through a million things to try to generate you insurance quotes, they can only, the profits don't work out unless they are just pushy salespeople. Whereas if you're just a computer algorithm running for pennies, we have a lot more flexibility about recommending you the best product.
Got it. And I guess then it might be a good time to ask, how does Coverage Cat make money?
Very simply, we're an insurance brokerage. Insurance brokerages get paid when they sell insurance with a carrier that we have a partnership with. That occurs a small percentage of the time for actual Coverage Cat users. So, most of the time, the best insurance is not even one that pays us, but because a small percentage of the time something does, well, that works out for us. You could think of it like most queries on Google don't lead to people clicking on ads, but a small enough percentage of the time, people do click on ads that it subsidizes the rest of the business, basically.
Makes sense. And I would imagine that because if you have the best quality results and more people use you, then that gives you more leverage to negotiate partnerships with more partners.
That's the long-term belief, yes. It's too early to say. The history of contentious relationships between insurance brokers and people desiring price transparency and carriers who often don't actually desire price transparency. There's a long history of tension there.
So on the topic of ML models, it's 2024, and I don't think we can have a technical discussion without talking about AI and language models. Where do you see essentially language models or the state of things currently impacting the insurance industry, and how has it impacted coverage cat, if anything?
I think I have a really unfortunate bias here, which is I am very skeptical of many of the promises that are coming out of the AI industry right now. And I think the moderates, the people who have realistic expectations, have mostly been driven out of that entire ecosystem. So if you are like, oh yeah, LLMs will produce single to double digit percentage improvements over the next 10 years in worker productivity, you're probably no longer even in that world. Whereas if you're like, oh, you're gonna replace all knowledge labor in the next 5 years, then your company's like doing well, I guess. Um, uh, so I don't basically believe that insurance and LLMs are gonna have a big thing in the next couple years. Insurance companies are incredibly conservative and incredibly bad at actually adopting technology. We use, virtualized COBOL mainframes from major insurance carriers that don't support Unicode carrier characters. So if you're going to tell me that that carrier is going to somehow adopt LLMs when they can't adopt an API, I don't know.
Got it. So I guess that is on the carrier side. But what about, the more nimble startups such as Coverage Cat? Um, how, if anything, are you guys leveraging the technology?
We do use LLMs in a couple domains. It's not in the places that you would expect. Remember that insurance is both a licensed and regulated activity, and promises that you make to your customers are sources of serious liability. So these are not. Right now, I think all of us can agree that LLMs are good in domains where accuracy is unimportant, and that is not. Insurance is just not one of those. So, to that extent, we don't use it in places where I've seen people suggest that they will replace whatever human agents. Not happening.
Yeah, one of the, I think, at least in a bunch of the VC talks or like analyst talks, I think a lot of people are bullish on, they look at compliance and how many people are needed to review everything, because I would imagine, it's hundreds of properties that are specific to each individual. And at the surface, if we can like hand wave aside hallucinations and whatnot, it's like that seems like a perfect use case. But I guess it's like the impression I'm getting from you is like, actually, no, we can't hand wave the hallucinations. It's the legal liability and the compliance liability make it that it seems like, at least currently, it's not really a viable solution.
Well, I think people say compliance and can mean very different things. Some people say compliance and they think about a an unyielding iron law. But if you've been in, let's say, banking compliance, compliance is an organization that balances business risk and errors and missteps with legal requirements. So for a company that, I don't know, maybe for Goldman Sachs, LLMs may be a very desirable compliance solution that nicely balances cost of compliance, accuracy of compliance, and efficacy. Um, for treating the insurance customer right, I'm less sure.
Got it. And for insurance, I guess one more thing too. What are kind of like well, I guess what is the challenges of setting up an insurance company? I mean, it sounds like there's a lot of regular oversight or like licenses you have to get, but I guess going in, if, somebody were listening and based on this talk was like, oh man, like insurance is such a broken industry. I need to do something in the space. What are things that they would need to watch out for?
Insurance is capital intensive. That's a huge problem just generally. And there are solutions to the ways in which it's capital intensive, but those solutions are expensive. So reinsurance is the simplest option. And you can find insurance companies that are carriers in name only. They're extremely thin layers that just wrap a reinsurance backer. So that's probably number one for startups. If you want to be a startup that launches a insurance product that you're financially on the hook for, you're going to need way more money than most companies that are not AI companies are raising. And then the second challenge is if you're not going to be that kind of company, then you have to partner. So there's partnerships throughout the insurance industry. Almost, I mean, you think of a really massive insurance company. Let's like take Progressive. Does Progressive sell home insurance? And you might think to yourself, sure, you go to progressive.com, you click home insurance. But that is actually a product in which they are reselling someone else's home insurance. So even if we're a company as large as them, they're basically like, oh yeah, auto is about all we can do. Maybe do motorcycle and trailer and stuff too. And that's like, I don't know how many hundreds of thousands of people work on those products, but how many years they've been in business, decades, and they haven't solved it. So if you're gonna like, oh, I'm gonna go solve every problem in insurance, the only way that you're going to do that is with a significant partner network. And so it's not the kind of thing where you can just wander in as a technology sophisticate and say, I'm going to solve all these problems with code.
Got it. Makes sense. Your co-founder, Gabriel, was the one that initially suggested we do this interview. And he also had some questions he kind of popped as like things that are good to ask masks. And one of them, we touched on this briefly before, is kind of your startup accelerator program or experience and how to make the most, or AKA hack, your accelerator program experience. I'm wondering how you would respond to that.
Like many things in life, if you can do backwards induction on your goals and the outcome that you're looking for, it's a lot easier to plan around that. But, circling back to the very first thing we started off with, undergrad, a lot of the times you don't know your goals, so it's tricky. Gabriel and I did Y Combinator with some pretty clear goals in mind, and that really enabled us to do it better, maybe? I don't know. We think that accelerators are a great opportunity to learn a lot about the current fundraising environment, see some pressures around fundraising, and effectively raise capital at prices that are good for your company. Maybe it's because we're slightly higher than median YC age or something, but I did not find them to have all the answers of how to make a great business. In fact, if I could just pick on YC for a moment, I think YC is almost a lesson in survivorship fallacies and anti-patterns, in that most YC companies fail, and the ones that don't do not in fact have repeatable lessons. Mm-hmm. If you go to a YC partner talk, they will often say things like, oh, 3/4 of this batch is now out of business, but one of these is whatever, Airbnb. And they're like, what's the lesson from Airbnb? And maybe one of the lessons is try hard, but that suggests that the 3/4 of people out of business didn't try very hard. And I think that's just simply not true.
Yeah, I think startups are hard. So much of it is, I think a lot of like timing and market and factors that are out of your control. Right. I think like the way I take, at least what I take from it is, being in a big market that is growing, and then setting yourself up so that you can adapt and be flexible and survive until you find, the fabled product market fit that will eventually lead you to grow.
And don't try to formally define product market fit, because that, it's really you'll know it when you see it kind of thing. Because if you formally defined it, then you could find counterexamples where people did have product market fit, but the company still failed.
Well, one of the, you mentioned you were looking for some answers that you didn't get out of YC. I'm curious, what were the questions? And
so why I'm a data-driven person. Obviously, my view on insurance is data-driven. And YC has one of the best possible data sets about startups in the startup fundraising ecosystem. But it's also clear that they are intentionally opaque regularly to both portfolio companies and maybe even within their own organization. And I wish that wasn't the case. You can if you go on LinkedIn, first of all, I'm sorry if you're on LinkedIn, but if you go on LinkedIn, you'll find people just shouting from the rooftops constantly a barrage of data about startups and venture capital. But it just is so skewed in its representation that I find it really disappointing, and I wish that there was better stuff out there. YC tries. I don't mean to be doing them an injustice, but it's also clear that full transparency is not what they really desire.
And when you say the data is skewed, just trying to understand that, is that mostly that focus on survivorship bias, or are you talking about other factors as well?
Well, let's choose a really basic one. What are the valuations that YC companies are raising at? Obviously, YC has a database of every valuation signing deal that companies are obligated to publish back to YC. And to what extent is that data visible? In the past year or two, they've added some data dashboards that shows you some quintile information sometimes, but it's very clear that it's not really visible. And I think that YC has correctly divined that it is not in their best interest or their company's best interest to actually have that information.
Got it. I guess I'm not going to speak for or against YC in this conversation. I would just imagine I used to work at Amazon. Jeff Bezos came from like a trading background. So there was definitely more of like a culture of like, let's not publish everything or let's not contribute everything to open source. And stuff like that has changed. But I mean, I just like, are there like or like simpler explanations for like, it's maybe they're not publishing it just because it is a competitive environment and it is data that they have that nobody else does. And
sure. I mean, if I was YC, my goal would be to maximize the expected value of every company. Unfortunately, there's probably things that are beneficial to portions of their portfolio that would be harmful to other portions. And it's clear that once let me choose a really specific example. What if they revealed that a lot of people were raising money at a $50 million valuation? Maybe companies at the who are struggling to raise would be like, oh, I'm not going to raise except at that kind of valuation. So just generally push prices up. And obviously, YC has long been trying to kind of do that, in that they build this kind of investor moment in which there's an information asymmetry that advantages the companies as opposed to the investors. So it's not like they're not savvy about these things. I just don't think, maybe I just really, really like transparency. That's all.
Yeah, and that's totally fair. That, I guess, in terms of coverage cat, like, what are your top line KPIs or metrics that you use to know that you're doing well?
This list is, I think we get into management philosophy a little here. So I believe there's really a measure that is really, there's like one number that drives your company. And if you're running an early stage startup, you should have that number, and you should know that that's the number that's either going to get you to your next round of funding or make it so the business is self-sustaining. And so for us, we're not geniuses here. It's just revenue. Like if business is making a lot of money, we're pretty happy with how the business is going. But the problem with using a thing like revenue as your sole number is that can really contort your business into doing bad things, making bad product decisions, etc. So we have just this fairly lengthy laundry list of other metrics that we use to basically keep ourselves in check, to know that we're doing the right thing for people. And so that's things like, how much money are we saving people? How rapidly are we responding to their requests? What's our cost of customer acquisition? What's the average policy that these customers are buying versus what they previously had? Like, those kinds of KPIs all are used. And individual product choices, which are hoping to produce revenue growth, let's say, are rarely so close to the source of revenue that they can actually meaningfully produce that. Like, let's say you worked at Google, and you made a great change to search. Maybe you improved search quality by like 5%. Are you actually going to see that in Google's quarterly earnings? I would say no. Like Like that's an unheard of level of change, by the way. 5% improvement in rated search quality. No. That's even something that extraordinary doesn't move revenue. At a startup, obviously, you're way closer to being able to move revenue with product changes, but you still are often making product changes that cannot be measured and are not discernible in that way. So you need these kinds of sub KPIs to track it.
Got it. And right now, what are your current priorities, and how often do you revisit that and plan?
We use a weekly cadence. I think that this is just salt to taste. If you're working on a product where you can change direction every 12 hours, great, more power to you, do it that way. If you're working on a product where you can not change for 6 months because you have contractual obligations or whatever, don't run a weekly cadence. So that works for us.
Got it. And for your team right now, what is the current size? And are you in person or remote or hybrid?
We're a 5-person company overall, and we are full remote, and we're all over from Eastern to Western time zone.
Has the remote setup worked out well? Or have there been any challenges that you've had to overcome with being all remote, or anything that works particularly well given that you're all remote?
Remote sucks. I think all of us know that it's a huge trade-off. But you know what sucks more than remote?
What?
The thought of your employees stuck in traffic, losing 2 hours of their life every day, the thought of not being able to access certain pools of talent, the thought of expensive office space that just is kind of wasteful. That's money that could be in the pockets of your employees. If you can run a remote company well, not everybody can, but if you can manage it remote, I think clearly it's the humane choice.
Got it. Are there anything that you guys do that you would classify as falling into the running it well bucket? Or
that's a lot of hubris there. No, I would say that remote companies work great when you can create an environment of high trust and you can create an environment of productivity. I think I have seen remote environments really struggle when people are saying things like, oh, I don't think that person's even doing work. You know what? If your company can't determine whether someone's doing work, you have a more fundamental problem than a remote problem, in my opinion. And a lot of businesses confuse time that your butt's in a chair in an office to actually producing value for the company. So the more that your company is able to structure itself where you can figure that out, I think the better remote will work for you. And the less able you're able to figure that out, probably the more that you're going to need to be in an office.
I recently read somewhere that the sales of mouse jugglers is at an all-time high. These are devices that will help move your mouse because a lot of enterprise.
I'm very aware.
Yes.
So I used to play World of Warcraft, which now half the audience will be alienated by. And World of Warcraft used to have a thing that would auto-log you out if you were inactive for a certain period of time. And so I built a mouse jiggler of my own out of Legos because at the time, scripting is against the terms of use, but an automated mouse jiggler was not against the terms of use. So if you wanted to monitor World of Warcraft auction house prices, you needed a logged-in account. And of course, how do you keep the account logged in?
Well, hey, if you wanted to repurpose that and sell it, I mean, there's a great market now for that.
I think that 10 years, whatever. A lot of time has passed. 15 years have passed. I don't think it's necessary for you to build your own anymore.
Now, how long have you been running Coverage Cat for now?
2 years.
2 years. I guess within the 2 years, I guess it's like anything you would do differently, or any big takeaways from the past 2 years?
It's very dangerous to take advice from other founders because nobody knows anything. And so advice is, people are, very confidently wrong constantly on advice. What would I do differently? a lot of what I do differently is I just be less of an idiot. I feel like I personally learned a lot of things that are not necessarily transferable pieces of information. It's more like, how did you learn how to ride a bicycle? Oh, I fell down a lot. Great. Just don't tell that to someone as advice. That's just.
Make
So
sure
yeah,
that you
I
scrape
think
your knees, at least 10
yeah,
times and have a few head injuries and you're all good.
great. Yeah, so that's I feel like so many successful businesses, and by successful I just mean high valuation or had good exit businesses, have founders who come on and confidently say, oh, the thing that made us successful was X, and if I could do it all over again, I would never have done Y. But it's just actually unclear to me, because there are businesses that go do Y and they're also financially successful, and then there's businesses that all go do X and never succeed. So I guess I've always believed that you should just be critical and cautious about advice, and know your own values and path. Do it that way.
Yeah. Well, I guess on that, it's kind of what are your values?
I used to think that maybe I just didn't have values, that I didn't really have beliefs, but then I did Y Combinator, and I came to realize that it is actually important to me that my company does something of value in the world. And when I say of value, I mean like makes the world better for people in some way. There's a lot of companies that do things that are close to economically useless and sometimes economically harmful. And I don't want to go to a company like that. Um, and I think there's a lot of people who are willing to do whatever it takes for the company to make money, whereas I am interested in having a company that takes care of its customers and takes care of its employees and is still sustainable. And I think those all make it harder. Those close off what you can do. If you want to, sell $4 t-shirts, you probably need to be employing someone somewhere in the world for $3 an hour. And I have very little interest in running a business like that.
Yeah, well, I mean, it does make it harder in terms of like it closes off your pool of available actions you can take. But I would also say, like, in some sense, like the hard part about startups, one of the many hard parts about startups is just persistence and getting it through the long game. And I think in terms of having a core values that are not just I need to make more money helps in that regard of being able to keep going when things are hard.
Maybe, but I also know founders who are incredibly ego driven. They literally want to be famous and rich themselves, and those people seem extremely persistent because they're just like so driven about that personal desire. And maybe if I had stronger personal desire, that would make me more persistent.
Yeah, I mean, I think it's one of the problems or the opportunities, right? Of like how living in the here and now is that there are so many people, there's so much information, there's so much examples. It's hard to have a iron fast rule because you will always find a counterexample or people that defy all the conventional wisdom and still make it. But I don't think that's to say that the conventional wisdom or like the counterexample is wrong. It's just that any way can work. It's just, what is your probability that it will work? And maybe the only way to get at that is kind of what you talked about earlier, is like transparency of having all that data available. I personally like to think that being values driven and mission driven ultimately is, for most people, is what's going to get you further than not.
I
But
like the optimism, but I wouldn't place my bets on that.
well, I there's a lot more that we could talk about, but we're getting close to the end of the show, and I generally wrap up with a set of closing questions. And the first question, and maybe this will go nowhere because we kind of talked about it already, but it is on advice. And if you were to talk to your founder starting off today, is there any advice, or maybe not even advice, but just highlights or things that you would tell them?
Try to plan out what is going to kill you what's going to ruin your company, make it so you can't hire the right people, pay them, go out of business, whatever it is, make you run out of energy and steam, and try to figure out how to eliminate or solve those problems or reach a conclusion about them faster. Because otherwise, you're just going to be put under the gun at some awkward point on them and not know. But that's really just another way of saying plan ahead, know yourself.
Yeah, well, I think it's more than that. It's I've heard this also called a pre-mortem, where you figure out, what could kill you. And I think with planning ahead, it's hard because it's such a large space to think about. And so something that is helpful is specifically thinking, what would it take for you to fail? I think the late Charlie Munger, one of his big principles was inversion of, what would you need to do for this to fail? And that at least for him, seemed to be a successful heuristic for navigating business and life.
Yeah, but you got to be skeptical of his advice, because one of his pieces of advice was like, do whatever you have to do to make your first $100,000 or first million. I forget. He's like, just walk everywhere. Economically, sometimes buying a car and going into debt is the right choice. I don't know. Don't ride a pony to work.
Right. So like maybe top line is like take all advice with a grain of salt, but like pick and choose on what will work for your situation. So next question: when you think of success, is there any one or anything, any action that comes to mind?
I think about the place that the world is at today, and I think about the place that I'd like it to be when I die. And to me, success is that in the very small ways that we can contribute to making the better version exist, trying to do those things.
That sounds very value-driven. And next, how do you recharge when you're tired, during a low light, when you lost a customer? What do you do to get back energy?
I don't know. Sometimes I go on runs, but it's not a catch-all. I get a lot of energy from helping customers get better outcomes. So if you're in a business where in a day you can make someone have a difference in their life, do that.
Are there any recent small investments that you've made in time or cash in the last year that have had an outsized impact on your life?
No.
Okay. What about if we go back the past 10 years?
I think I'm someone who has pretty strong buyer's remorse. If I somehow could just have not bought anything in life, I think I would have been happier about that. But, I'm sitting on a chair. It's nice to have a chair.
Yeah, nice to have a chair, nice to have a car to get around. There are certain things.
I don't have a car, so,
No.
I can't cancel that one out.
No. So go back to walking in Uber. Yeah, it's funny that we talk about this because as the day of this recording is also corresponds with Amazon's Prime Day, but I'm kind of with you of like, it's realizing getting things were a mistake versus not more of the time.
The way that I think about it is for millions of people, scarcity is a constant economic pressure on their mind, and they're always stressed out around scarcity. And if you can make it so that you're just happy with less, well, that really that's one within your control.
Absolutely. My last question, it's a 2-for-1. Do you have any ask of my audience or any offer that you would like to make before we close out the show?
If you have insurance problems or want to find if you have a better option, use Coverage Cut. I would love to help you. My team would love to help you. Give it a shot.
Yeah, I would also like to add, I have gone through the process and it was smooth. And there was an option, I don't know if this is true for all the insurance policies, but it was the would you like a call from Max button?
Yes. just for the sake of my calendar, it's better if not everyone clicks that button. But yes, so that I definitely call customers pretty regularly.
I think that's awesome. We'll have the link to Coverage Cat and everything else we talked about in the show notes. And in the meantime, Max, thank you so much for coming on. This was a fun conversation.
Absolutely. Pleasure to be here, Kevin.
Hey, just one more thing before you go. Thanks for listening to this episode of Founders Table. If you like the show, please subscribe in Apple Podcasts, Spotify, or wherever you get your podcasts. Also consider giving us a rating, as it helps others find the podcast. You can find all episodes as well as more information about the show at founderstable.co. Until next time, stay hungry.